Christian. Thank you for inviting us to this opportunity to present our fund. I would like to begin speaking a little bit about our investment process, which has a lot to do with our personal background as managers of Equam. Because both of us, my partner José Antonio and myself, have a private equity background. We have been investing in private companies for many years, and we have been involved directly with the managers of these companies. So we're used to that. And this background has a big influence on the way we are generating ideas and the way we are analyzing our investment opportunities. So this first slide, I would like to highlight some of our checklist or our investment criteria and how our private equity experience influences our process. Probably most of these things are not new to any one of you, but there is an influence from our background. So first, idea generation. We believe it is very important, and we place a great focus and dedicate a lot of time to generate new ideas. If you don't generate enough potential ideas, it's very difficult to find the good ones. So that's an issue to which we dedicate a lot of time. And we don't run screens. So what we normally do, What we normally do is we like to talk to people. We have board experience, and we're, as I was saying, used to this. So we prefer to identify ideas through talking to people, to managers. We go to equity conferences, organize roadshows, and from that we generate many ideas that are different to what the market is looking at. We like sound businesses. When you're a private equity investor, sometimes you leverage your companies. You require the stable cash flow generation, otherwise you're going to be in big trouble. So we are used to looking for these sort of opportunities. We are looking, the translation of that to our process is that we are looking for profitable oligopolies. We also have experience with leverage. We've seen many colleagues run into problems because of leverage. So we are now excluding leverage from our portfolio. We don't like leveraged companies. We like owner-occupied enterprises. So we've witnessed the power of entrepreneurship, and we want that to be part of our portfolio. And of course, we are looking for low valuation, and we do our own research. The idea I wanted to talk about is Rieter. That's a Swiss company. It's a Swiss manufacturer of spinning machines for the textile industries. It is a 900 million Swiss francs company with net cash of around 200 million and revenues of 1 billion, and a global market share of 30%. This company has 3 divisions. The first division, the machine and sales division, is a very competitive. It's in a very competitive industry. As you can see here, it generates most of the revenues, but this year it generated almost no EBIT. And it is a very cyclical business, very competitive, and well, very tough, of course. But then the company has 2 other divisions which we like very much. One is the after sales. They give consulting services to the clients to allow them to improve productivity, to reduce load times. And they also produce components which are very specific to their clients. So these machines, what they do is they get cotton, and they get all types of fibers, and they spin them into yarn, right? So there's a part of this technology which is very basic. It's rotors, electric motors, and they assemble all these elements in the machine and systems division. And then there is a part of that machines that is the component which is in touch with the fibers, which the clothes. And this, believe it or not, it's a high-tech device. This is the part of the machines that allows to improve efficiency, to reduce the breakage of threads, and they are the only ones heavily investing in research and development, so they have a big advantage compared to the rest of the competitors. These 2 businesses are very profitable. They are very stable because they do not depend on the CapEx cycle of their clients, but they depend on the installed base of machines. So these 2 parts are very good. They are current business and profitable. Right. Basically, this is a description of the company. The market is growing, so this is not a dying market. It is growing at a 2.5%. It's expected to continue growing in the coming years. And Rieter's share of this market, of the available share, is half, because they are only involved in the production of spun fibers, which are cut. So there's the other half of the market is the man-made fibers, which is made of filaments, continuous threads, that's dominated by other players. So they are involved in half of the market, and they have, as I was saying, a 30% market share, which has been growing in the past from 22 in 2010 to 30%. We believe this is a very remarkable feat of entrepreneurship. The other players are, it's difficult to get market share information because there's Laxmi, an Indian company, which has a very strong position in India, and there is Jingsheng, a very strong company in China, which are the main markets. Then, as I was saying, we focus and place a lot of attention to the board and to the owners of the company. Rieter is owned by two entrepreneurs, Michael Pieper and Peter Spuller, who sit on the board. These guys are very strong entrepreneurs. Peter Spuller bought a company from his grandmother-in-law for $6 million in the 80s, and it converted it into a $2.2 billion company. It's a rail wagon company. It's a very tough business, but he was able to internationalize the company, and I think he has a very good experience in a similar industry. And Michael Pieper is involved in kitchen hoods and real estate, also very successful in taking his family company to the world. And these guys, as I was saying, have a significant share and a significant position in the board. And we believe this is very important. We are firm believers in the alignment of incentives. In the past, for example, Rieter did a spin-off of one of its divisions. We think this is a very shareholder-friendly decision, and I'm sure it was thanks to these two guys being there. They are now shareholders of that other division too. And you can also see the way the management is paid. It's very reasonable. So they are paid a fixed salary, and then they have a bonus, which is 100% of their fixed salary, and they're paid in shares. So it's reasonable. When you have good managers and good entrepreneurs sitting on the board, you're going to have good things happen, no? And another important thing is that some things I'm going to talk about in this presentation are also the result of having good entrepreneurs here. They are focusing on this after-sales market and components market, which is recurring, which is a high return on capital business. They are doing restructuring, and these sort of things you have to have someone powerful to manage that. Then a quick word on where Rieter is selling. Rieter has followed its clients along history. Some 100 years ago, all the spinning machines were in the US and were in the UK and Europe. Now they're all in Pakistan, Bangladesh, China, and India. So they've moved their capacity to follow the clients. They are very strong in Bangladesh, Vietnam, which are the countries which have a better prospect because they have a lower cost compared to China, so they are gaining market share. They have a small relative share in China, which is a very important market, but it's more price-driven. And they're very strong in Turkey, especially. Turkey is investing heavily in this industry. They are cotton producers, and they're growing, and they're at full capacity. And one of the things that has affected the performance of this company this last year was the situation in Turkey and the situation in India. No? The demonetization of some currencies created lots of problems, and in Turkey, the attempted coup also has stopped many entrepreneurs from investing. But we believe this is going to recover. Okay, and the problem is that if you see this from a screening point of view, you're going to find a company that is trading at 22 times PE and 13.5 times EBIT, which we believe is a high valuation. What we do at Equam is we try to through understanding the business, try to normalize the results and try to understand what would this company generate in a normal year. And for this, the first thing we are looking at in Rieter is the CapEx cycle of the industry. So here, their customers buy machines when they are doing well, and they stop buying machines when they are not doing well. But the situation is that the demand, as I was saying at the beginning, is growing by 2.5%. It's expected to continue growing. And if you don't invest, there will be a time when everybody will come back with new orders. That's one thing. And the other important element in the CapEx cycle is the lack of investment for 4 years. So this has not happened in many years' history. In 2009, there were 2 down years. Now we're having the 4th down year. The capacity of the industry is measured in spindle equivalent, which is the machines that produce this yarn. We are now clearly below reposition levels, and we are installed capacities at around the levels of 2009. So here we have various effects. So it's the aging of machines, it's demand growing, and it's some machines that are coming out of the market. According to the company, you can run a mill for 2 years without investing, and there's no problem with that. But after that, quality begins to be compromised, and you have to invest. And then all the orders come at once. So that's one thing that we believe will get normalized. We think that we will get back to 2013, 2014 levels. We are not assuming getting back to 2010 or 11. And that would generate a recovery of 35 million in EBIT. Then there's the restructuring effort. This company has been continuously restructuring. 3 years ago, they had 18 factories. Now they have 15. And they continue to close production in the high-cost areas and to shift that production to China and India, where it is cheaper to produce. They have just completed a restructuring program, which with expected savings of 15 to 20 million, and they announced last February another program to cut costs in Germany, in Ingolstadt, for 20 million, which is expected to be analyzed in 2019. And here what they are doing is, like many other Swiss companies that are being punished by the Swiss franc, they're moving production outside Switzerland and retaining the high value-added business of research and development and patents and other these sort of things. And then the third area in which we believe the company can improve is this focus on after-sales and component business. They are investing heavily in research and development to improve the quality of their spindles. So it's 5% of revenues for this sort of companies, very high, much higher than all their competitors. And they are also training their sales force to help them promote after sales to their customers. And they want to win a greater share of wallet from their customers in after sales, in consulting services and managing the mill so that you optimize productivity. So all these three initiatives together, or initiatives or events in the case of the cycle, will improve generate a much higher normalized EBIT. Here I'm presenting the historical EBIT by division. It's only since 2014 that they began to publish and separate the after-sales business. But we can see here the very high stability of these components and after-sales, and very cyclical nature of the machines. We are now at such a depressed level that this division is generating no EBIT at all. And we believe that if we get back to 2014 levels, that means 850 million revenue just in this division, when today they are doing 600, with on average margins. That would generate 36 million. The restructuring, we are assuming just a share of that 30, 40 million. And the growth of the component and machine and after-sales business we expect to continue as it is now. So all these three together make us see this company with a 57% upside, We tend to do very simple valuations. Once we understand the business, we want to have a back-of-the-envelope valuation which we can check when the market collapses so that we can easily know whether we're right or wrong. So we're trying to value this on 11 times EBIT and adjust for the cash, and that's it. So basically, this is our idea. We think it's good because it's under the radar. It's covered by a few local stocks. The last 12 months financials are not representative of the company, so many people may lose it if they do just a Bloomberg screening. We think it's a sound business. The component and after-sales business is good and stable and predictable. It's got net cash, it's owner-occupied, and the valuation is very attractive, according to us. So this is my idea. Happy to take your questions.
Hello, thank you very much for the presentation. I had a question. Who would be the main competitors? And do you think that China could start competing at lower prices and take market share from them? Or is it all more technology-based?
The market structure is, in India, there is a very big player, which is Lakshmi Machine Works. And in India, there are two big players. One is Jinsheng, and the other one, so I don't remember the name, but they bought a German competitor, so they are also very strong. And of course, competition is very tough here. They could gain market share, but the fact is that they are losing it. And also there is the situation in China that the government is promoting an investment program in Xinjiang, in a region where they have lots of problems with the Uyghur minorities. And to compensate for those problems, the government has a 10-year investment plan in spindles. So the Chinese companies probably are going to benefit more than Rieter. And that would make them probably lose a bit of market share because they are not present there.
Thank you, Alejandro, for your presentation. Maybe you already answered my question. It was going to be, what is for you risk number one for this company? Maybe this thing about China and...
Yeah, well, I think this is a very cyclical business, and if the cycle gets on and gets further down, that's a main risk. That's one of the reasons why this company keeps a permanent cash balance. So they could give out this cash, but they are not doing that. They have a 40% payout target, but they have to keep cash because the cycle can be very tough. That's, for me, the main risk. And that's why if you have a leveraged company in this industry, that's very dangerous. But we believe that having this sound balance sheet is a good protection for that.
Thank you very much for your presentation. I have a couple of questions, if I may. The first one is regarding the margin of the clients of those machines. What is the EBIT margin if you have some idea about what is the margin of your clients? And after that, what is the life of one of these machines? Yeah. Thank you.
First, the margins. The margins depend very much on the yarn price, and then on the cotton price. So it's different in every country, but those are the main drivers, and they vary very much. So the years when the yarn is high, they get money and they invest more. I've been seeing some papers on the competitive difference between China and not on a client-by-client basis, but on a country basis. And China is losing competitiveness in this industry in the favor of Bangladesh and Pakistan. So that's all I can say about it. And the other question, sorry, It
was regarding the life of
machines. These machines last for 20 years, but the components wear out in 2 years. So you can use the machine for a long time, and then energy efficiency and quality begins to be compromised after 2 years. So.
Hello. Thank you very much. Actually, we are also shareholders, so we support your idea. I just wanted to have your view on, they have a pension fund that is very strongly overcapitalized by, I think, more than 200 million Swiss francs. I just wanted to have your view on how you incorporate this into your valuation.
Yeah, we didn't include it. This company has one of the few companies that have greater pension assets than pension liabilities, which is not so common these days. And the problem with pension assets is that you cannot normally recover them. So you put them in the fund, and it's very difficult to claw them back. We didn't put it into the valuation. So, in fact, we adjusted the cash balance on the other sense, because the company has 87 million in advances from customers. It's sort of engineering company, so they receive advances. We excluded that from cash, so they have 87 million more than we said. And on the pension, we didn't adjust for that, yeah. It's another positive.